conducted a conversation about the fraud and dispute outlook, and there's been a lot of talk around early warning and real-time payments. And so I wanted to put the question to you folks as experts in the industry, just what are you seeing with fraud on the rise, difficulties with institutions being able to manage this in-house for this problem?
I would say for Zelle and the situation over there, it's a little difficult right now for financial institutions because they feel like they're pressured into participating, but maybe not necessarily aware of how to prevent fraud or given the right tools. So they're trying to feel their way through what the experience should be for account holders and for credit unions for their members. So I've seen a lot of, what should we do? How much should we accept as far as dollar amount limits and things like that? We've seen some large financial institutions take heavy losses due to fraud. So it's a growing industry and it's something that everybody's excited about, but there are still challenges to work out on the card side of things. Fraud is still very much prevalent, but there seems to be a lot more, systems in place and practices that are out there, and things are quite consistent. And I see a lot of inconsistency right now in real-time payments.
I would definitely agree that there is sort of a sense of excitement with banks, right, as we introduce additional mechanisms to transact, but also a looming sense of fear on how to secure these transactions. A lot of the focus now on that security side is in the fraud detection space, right? So sort of outside of our purview, and that makes sense, right? How can banks verify when these transactions are occurring that the parties are who they say that is the biggest challenge that banks have today. And there's definitely solutions around that. I mean, some banks looking at biometrics and things along those lines for security purposes and understanding secure logins and authorizations and that piece of it. And it's really just about understanding who the two parties are that are involved in the transaction, as well as the second side of that would be ensuring that. And I haven't heard much about this, and Dave, maybe you have, but I don't know what sort of first-person fraud looks like in this space. I've got to imagine it's a problem that maybe nobody is really talking about at all yet because they're so concerned about just the security of identifying the right people.
There's so much true fraud going on, right? Like with such a high amount of that, like everybody knows there's true fraud right now happening in these networks, right? And it's like,
right,
you almost can't even bring yourself to think about first party fraud, at this point. But that is it almost feels like kind of the next frontier after we've kind of figured this out with fraud detection and everything. It's like, well, okay, great, biometrics. Somebody put their fingerprint on it and then still claimed it was fraud. And there's Reggie out there saying that you have to investigate it. How do you actually do that? You go see if somebody cut their finger off, or what's the plan at that point? Because the CFPB's made it pretty clear that consumers need to be protected through this stuff. But first party fraud's it's a huge problem in the card space, and I don't necessarily see it not being a problem in real-time payments.
Right. I mean, and that's exactly what I was getting at, right? So from our perspective, I mean, the security piece of this, and fraud detection and that side of it, banks will sort through that as best they can, just like they have with cards, right? There's always going to be some amount of fraud that's going to come in the door here because there has to be. Meaning, the only way to eliminate fraud is to eliminate the transaction types altogether. And that's not good for anybody. Consumers want to do this. I'm still curious, and I know that the base or that those types of companies and the exchanges that are putting through crypto, right, and the technology they use, I still think there's opportunities for blockchain here to make this more secure as well, and these types of payments. So wouldn't be surprised if we saw some of that on the front end. But like we were talking about, even with better technologies, even with better security metrics around this, there's still going to be an amount that comes through the door. And I think that's where we can come in on the back end and, understand if this is actually true fraud or if this is a first person situation. Because imagine being able to, drop $1,000 in somebody else's account and then being like, I didn't do that. Right. And then what do you do? Right. Like how, because I think that's where the regs are ultimately going to go, is they're going to protect that consumer and force the bank to essentially give that consumer that $1,000 back. But who knows, right? I mean, maybe they gave it to somebody and it was their friend or somebody they knew or an acquaintance, or maybe it was a completely fictitious account made with a synthetic ID. Who knows, right? And like that, I think is where we're going to have to focus in the back end and protecting banks' ability to recover these funds once this is a little more heavily regulated. We'll have to solve that problem in the back end.
Yeah, and since these payments are real time, the money's gone. They're essentially wires, and if there's any kind of illicit nature of the transaction, that money is just straight up gone. In the card space, we have an authorization that we can attempt to action on and things like that. But like by the time we see it in QFD, the money is already gone, and we've seen that already in the prepaid space. So we've got a lot of experience on that. It's very similar to where somebody pulls the money off the card, gets cash for it, and they're simply gone, and it's a loss for clients. So the real-time nature is exciting on this stuff, but it puts a lot of pressure on the back end to figure out what actually happened. Were they actually the victim of fraud, or is the account holder actually participating in this? Because it can be a lot of money, and you're never recovering it from anybody.
Speaking of wire fraud, have we seen any type like data or trends as far as fraud and dispute management, or increases in fraud trends with wire that we can learn from, or RTP?
So for wires, wire fraud's always been a thing. People reach out and attempt to get funds wired to them quickly. That was a problem probably in like 2015 type of thing. You'd buy something on eBay or something and say, hey, I need to get a wire for this or whatever. There was a lot of like scams around that. And what happened is you saw banks put up a lot of walls around wiring funds. And now you practically have to have a conversation with somebody if you're going to wire money over a certain dollar amount. You see something almost similar right now with Zelle. So, that kind of friction helps reduce fraud and helps prevent people from becoming victims. But it lowers the efficacy of the product. Right now, I can't actually just send a payment whenever I feel like it. I gotta get somebody's permission. So we haven't seen wire fraud be as prevalent because of all of the friction around the product. And I think that's where, you look at something like Zelle and it's like, well, how do we solve the problem that we still kind of have, right? There's people out there asking for money who maybe aren't entitled to it. There's people sending money who are later going to say that wasn't a good idea. Those problems still exist. And as far as I've seen, the biggest solution from banks so far has been friction. And, I don't think consumers overly want that in their experience.
Yeah, I mean, we see that. So, I mean, there's definitely, it all ebbs and flows, and I think, like Dave said, there's that the rigor around the wire process has certainly helped, I think. But then, you look at something like what we have seen in the market is check fraud has gone up significantly, which is crazy, right? Because who's using checks? So, kind of what happened, right, is people, banks sort of stopped paying as much attention to checks because they were dealing with card and trying to get card fraud under control. And so nobody, I don't want to say nobody was minding the store, but it kind of, that's kind of what happened in the industry. And then all of a sudden, fraudsters started to figure out, a la, catch me if you can, right?
Yeah.
Figure out how to pull off large scale check fraud, and when it was significant. There was a sort of especially last year, a significant movement in the check fraud space, and now banks are starting to get that under control. So it's like this ever sort of evolving, game between banks and fraudsters and what they can tackle next. And they are certainly looking at RTP and Zelle and even ACH. We see a good amount of ACH fraud still out there. And you know, and all of those things again are, how do they cut it off at the pass? But then secondarily, if they don't and fraud gets through the door, which it's going to, how can banks recover? And there's some work we're doing there, right, in the back end on that recovery piece. Dave and team have got some really cool things lined up this year for ACH specifically on how to automate more of that process to get that money back from the original bank, right, as quickly as possible, right, and that all matters too because it's timing, right. David mentioned prepaid earlier, and when that money's gone, it's gone. That's not always true with these transactions. Money's still there for a few days, and there is a chance to recover it. So even if you let fraud come through the door, if you can catch it quick and recognize it, there's an opportunity to get that money back from that original bank if you do it fast enough and you're automating that process, which is certainly a place where we come into play. And like I said, Dave's got some good stuff on the roadmap for that this year.
Yeah, on the product side, we want to make sure for ACH disputes that we're actually reducing the friction as much as possible. It's right now a process that is somewhat cumbersome for consumers. If you have a card and you're a victim of fraud, you call your bank up and say, I don't recognize these transactions, you're pretty much done. And they will take the investigation from there and let you know what happened. For ACH, it's like there's rules about how much time you have to report this, and then you have to sign things, and like who wants to print things out, or who really wants to use DocuSign. It's a great solution if you require a signature, but do we actually need one? So as we started to dig deeper into that and pour over the laws and all the nacho regs and stuff, you can kind of find a solution where no, we don't actually need that signature. We don't actually need that form because we already know who this person is. We've got a recording of them. We've told them that, they can only file a claim if they're a signer on the account, and we figured it out. So that's definitely an exciting change because, as I mentioned, like we've got banks increasing friction on some of these processes, and our goal is to reduce the friction as much as possible when the transaction already occurred. We've got to shorten the time frames. We've got to make it easy for consumers to get through the process, and we've got to get to the bottom of the matter as soon as possible. So talking about true fraud versus first party fraud, that's also top of mind for us. Who is this person that's reporting this? What kind of history do they have? Do we have reason to believe their story? If a bank stands to lose $10,000, they need to do a little research, and they're required to do that research. So what information can we put at their disposal to help them get to the truth of the matter as quickly
as far as P2P fraud and how banks are managing the fallout from, disputed claims, and how those fintechs are managing it too or not managing it. What is your guys' opinion on that as we move into 2023? I know there's been a lot of conversations about these tech companies being too big to fail and also maybe too big to regulate, so to speak. There's a lot of CFPB complaints around, some of the big giants like PayPal and, their other company Venmo about, not responding to consumer complaints when it comes to disputing transactions, and then them passing it over to the bank, and the bank is like, well, pass it back to PayPal. What do you guys see as, as the industry addresses that?
Yeah, it's interesting. I mean, first I would say, regulation is coming. It always does, and banks obviously are heavily regulated today, right? And they will continue to be, and these types of transactions will as well. What's tricky about P2P is, and really a lot of these transaction types is unlike card, where you have Visa and MasterCard who make some rules and can, decide liability. It's the Wild West, right? Like this is like who decides who is liable. And usually, how it ends up is, whoever doesn't have the money, right? It's now the liable party. And that is unfortunate, right? Because people are trying to follow the rules, and people are trying to, and by people I mean banks, right? They're trying to offer this service to their cardholders or to anybody that wants to transfer money. I don't actually know how that plays out. I mean, I don't know if ultimately the government will step in and sort of mediate that in the way that networks do on the card side. There has to be rules, right? And I think at some point if there are no rules, I do think consumers will start walking away from some of this technology. Fraud is only going to get worse, and people aren't going to want to use their money and send somebody money for a transaction when there's no guarantee that they receive whatever goods they're supposed to get, right? So that's why it makes these sorts of transactions so hard for retail, right? I mean, a lot of this P2P stuff is just people, shipping money to their buddy because for a pizza, right? Like that's what these transactions are. And if there's an expectation that this is going to grow to be a more useful global tool for retail and consumer, then there has to be some rules and people have to feel secure, right? You can't, I mean, imagine, ordering something and paying somebody through Venmo and not getting it. And then you just, what, right? You just kind of like look at each other and like, what happened? Like, I like, what do I do now? My money's gone. So I think, if there's a real desire by the market to use these transactions in a more meaningful global payment way, there has to be some rules in place. And it's the same way I feel about crypto. I mean, I think it's fantastic, but if there are no rules about who's liable when shit goes wrong, then people won't use it because people aren't okay with just giving their money away and not having any assurances that that they'll receive whatever good or service or product they're expecting to. So I don't know how it shakes out, but I just know that it won't grow unless there ends up being some rules around that stuff.
And now
Yeah,
you're
I mean,
seeing they're playing with crypto too. Like Venmo is offering, if you
yeah.
buy crypto with
Like,
your
let's
Venmo
double down
balance.
on the risky
Yeah.
transactions, right? I mean, in the news, everybody saw, issues with actual crypto exchange and fraud, right? Like that's something where you're not going to see that in the banking industry because it's so heavily regulated. And there's like this pendulum effect, people run away from banks because they don't want Big Brother watching them, and then they conduct their transactions with somebody that they don't actually know who's not regulated. They lose a bunch of money, and then they want regulation, right? I mean, you will actually probably see people asking for regulation at some point. Visa and MasterCard are kind of like this thing that like merchants don't necessarily like because they have to pay them. Banks don't necessarily like them because they have to pay them. Consumers kind of like Visa and MasterCard because they have put a system in place. Visa and MasterCard used to run a network, and they still do, obviously. And the value of a network is far less interesting these days. There's computers and networks everywhere. I'm surrounded by 700 networks right now. But the other thing they offered was the security of the transaction and dispute resolution afterwards. And that's where, we play in that space a lot, obviously. And it's like, what happens after the transaction if something went wrong? And Visa and MasterCard have a very clear answer for that. And they even show up with money. They show up with money that comes from the merchant and the bank. And that's why, they're not super thrilled about it. But there's a process in place, and there's a way to get that money where it ultimately should go. Is there the same opportunity or the same sort of mechanism at this point that Visa and MasterCard are providing for Venmo or PayPal or Zelle or RTP or all that stuff? There's Nacha for ACH, does a serviceable job, but consumers, they will demand to be protected or they won't use it. And not only that, Visa and MasterCard are already doing this. They're right across the street. So you got to pry this card from somebody's hands, and they're starting to realize that the grass may not be greener.
Well, and Venmo and PayPal. I mean, PayPal's been doing this for a while. Venmo just launched it, but they issue these like Venmo debit cards now too. So
All right.
it's interesting to
So
see
all they
how.
did, right? So that's such a funny thing because they couldn't
Whose
figure out how
logo
to
is
solve
on
this
that
problem.
card?
Yeah,
Right,
I mean,
I think MasterCard is
Oh,
PayPal.
of course it is.
right. And I remember, talking last year at Money 2020 or 2 years ago, Money 2020, and that was the big year, and all the crypto folks were there, and they were like, "Well, we're not regulated, and we don't have to worry about this." And then I was talking to one CEO and founder of some crypto company, and he's like, "Well, what we're doing is because our holder retail, so we're just letting them load a prepaid card." And I was like, well, yeah, now that's a card, and now you're subject to Reg E. And he was like, well, no, I'm a crypto company. And I was like, yeah, nobody cares, right? So I mean, and now like Venmo, right, doing the same thing. So here's the money loaded onto this debit card because that's the only real way to get these funds to be used for commercial purchases. We're right back where we started, right, with card rails. And Dave and I have joked about this before, and it's like, man, all this money movement stuff, and like I get it when you want to give somebody money quickly, but that's all that it's ever going to be good for. They're never going to solve this problem of large retail purchasing because it's not protected. And it seems that that's how they're going to solve the problem is they're just going to use cards, right? They're just going to use the Visa and MasterCard rails and solve it that way. And which is great for us, right? It's fantastic for us.
Yeah,
It's
I don't
exactly
hate
how we
that
want
at all.
people to be.
You know,
Yeah.
it's not
So-
particularly innovative, you know?
Right. So unless there ends up being some governing body, then it doesn't matter, right? And the whole beauty of P2P is that it's quick and there is no governing body, but then that's risk. And it's kind of circle of life, and we're right back where we started. I mean, imagine with card, you have this thing that's now on your phone, right? Or your watch, and you can go anywhere or you can go online. And within seconds, you can exchange money for goods. Well, how do you get better than that? Like,
Yeah.
like what's better than being able to buy anything in the world from anywhere in the world in like sub 1 second? Like at some point, you just have to understand that maybe the payment technology is kind of as good as it gets. Like, unless you can predict what I want to buy with my brain and like read my
I was
mind,
literally
like that's
thinking
the
Yeah,
that.
like
telepathy
next
is the
step. I mean,
next thing, I guess. If I can, walk up to a checkout at a grocery store and just like do this and like pay and walk out, then I guess you've made it better. But like,
marginally.
I was in New York a couple weeks ago and I took the subway. I like taking the subway, and I've gone to New York for 30 years, whatever. Used to drop coins in the thing that you would get from the attendant at the booth. And then they introduced these little cards that you would get from a machine and everything. And now they've got a system where if I have a tap to pay card, I tap the card. And it's so like I'm walking down the stairs, I tap my card, I don't even stop walking. And it's like, I don't know, I don't need crypto or Venmo or anything in my life to solve that problem. It's not, I don't have a problem. I'm good.
Right, right. And that's where like I struggle with all these transaction types. Again, like outside of just sending money to another human, like and just a pure money exchange, I struggle to see where this goes from here outside of again like offering a Venmo MasterCard. That now makes it useful, right? Because now somebody can Venmo me money and then I can go spend it on that card. Right. So that is a useful tool, right? But again, like for large scale retail, like they're still going to use the card and the Visa and MasterCard rails. Maybe somebody can come along and make that process, that network process cheaper, right? And maybe that's the next evolution, right? I mean, banks and merchants pay price for Visa and MasterCard, and especially in this dispute world, banks are paying for chargebacks and merchants are paying for chargebacks, and it's not an insignificant amount of money for anybody. Maybe somebody comes along as a less expensive alternative to Visa and MasterCard, but several have tried, all have failed or been purchased, right? Like that's
Yeah, some
yeah.
of that money goes to actually, paying out fraud, right? Like you have to have interchange funds that fund the system so that when there's a loss, there's money available. That's how banks are able to take losses by getting interchange. But Visa and MasterCard are also two of the most profitable companies in the world. So there's clearly Bezos used to say like your margin is my opportunity, right? And like there is still that kind of concept where like these guys are making money hand over fist, but the irony of it is they're doing it by pleasing consumers And the consumers drag the merchants and the banks along. They don't care that your merchant pays Visa when they swipe their card. They just don't. And they get to rule because they're consumers, right? So it's Visa and MasterCard put themselves in a very lucrative position, and I don't see them being, unseated, at least in the like merchant purchase world anytime soon.
Joe, you made an interesting statement. He's like, I don't know how payments can get better than where they are now. Do you think that the attempt to, over, I don't know, make payments over the past, I don't know, 5 years has or is partly responsible or all responsible for a lot of these fintechs failing recently? We see, a lot of startups, they're trying to solve for maybe,
Oh
underbanked
yeah.
populations or trying to find a new payment solution. And now we're seeing them all kind of crumble after, their COVID financing and stuff.
I think a couple of things are at play there. Certainly the innovation in the payment space, right? And that's what some of the processors are out there trying to do, and they're trying to look at some of our clients like Galileo, right? They've got a good idea, right? And their idea is because if you look at old issuers, they're using old technology. They're solving all these problems with massive amounts of people. B of A's got, I don't know, 280, 300,000 people, JPMC Wells, like they all have hundreds of thousands of people, and they're solving all these banking problems with just bodies, right? So along comes Marquetas and Galileos, and they're like, well, we can solve this with technology. Let's automate as much as we can, right? I mean, the core banking engines that are out there, I mean, they're old, and I don't mean old like 15, I think 40 years old, right? I mean, this is old
Look
technology
at
that's
me.
sitting out there. So I love the idea of fintechs, right? And trying to solve the problem from a technological viewpoint. The problem that they're having is, you know, I've heard that people aren't as loyal to their banks as they used to be, right? And I think that's generally a true statement, right? Like my parents, my grandparents, the same bank their entire life. I have switched banks 3 times, like with like significant bank changes in my life. I think people that are a little younger maybe are a little more prone to change banks even more often. But you know what they're doing? They're just changing from the same 20 banks. Nobody's going to some bank, maybe a credit union here and there, but like people aren't super excited to sign up for something that they've never even heard of this company before, right? They're still like, yeah, Wells Fargo is a good deal for me, right? Because they can offer better loans at lower rates because they have more assets, right? So you just like it's very hard to break into banking and be special. So I think what some of the fintechs are trying to do and solving with technology, and I think some of the cool things and a space that I see growing that really has potential is the idea that any retailer can be a bank, right? I think it's maybe special and will take off. If you look at Walmart and One Finance, I mean that's the largest retailer in the history of the world trying to do their own thing in banking. And rumors about other live tech firms. Okay. So yeah, so I think that the technology advancements in banking and the retail space becoming banks and being able to service their own customers, I think has a lot of merit. The banking as a service stuff, I think what happened was some folks saw the success of the first few players to enter into that space. They got a lot of funding, huge capital raises. Then all of a sudden everybody thinks they can do it. And I think it got flooded. I don't necessarily know that it was a problem with the idea. I think just too many players came into the space and they got too much money. I see that across tech, right? If you look at what's happening now, Elon Musk sort of made the first step with Twitter, was like, hey, we don't need 7,500 engineers or whatever the number is to run this place. Like this doesn't make sense. Now you see all these other tech firms starting to lay people off, which I hate. Obviously, you don't ever want to see somebody lose their jobs. But I think what you see is, and we see it on a small scale at Quavo, we actually manage it very, very well. You don't need massive amounts of capital and technical engineers to build technology to solve a small number of problems. I mean, a bank does 20, 25 things maybe, right? If you're a credit card institution, you do even, it gets a little weird, right? When you try to bring in thousands of engineers because you did some huge unicorn capital raise and solve all these problems. And I think they've overextended. They've spent too much of their capital. They spent it before they had any real money coming in because there was so much competition in the market. So I don't think it's a failure of the idea of banking as a service or trying to find niche, space to play in, like the underserved, right, and underbanked. I think it was just a matter of too much capital, especially through COVID. I mean, capital was just everywhere. Everybody thought that they could start their own banking as a service company. Some of them will come out of this and win. Some of
Yeah.
them will lose, right? And it's just how it's going to work. It was very similar to, the late 90s and the dot-com, and everybody got in and there was a bunch of money, and you can only have so many winners, and people won, right? Amazon won, right? They came out of that as a Google won, right? So there are going to be winners, but there's going to be a handful of them that come out of this banking as a service and fintech processing space that are going to be on top. It just, it'll take some time to sort through who it is and figure out who does it better and more cost effectively.
We've always had a very gold rush culture, probably since the gold rush. It's like, oh, there's gold in California, and everybody from, Virginia moves to California, and it takes 6 months. And by the time they get there, if they get there, a bunch of people got the gold and there's nothing left, and it's like you still see this playing out all over the place. And the same thing I think has happened with fintech processors and banking as a service. Like at some point, the gold you're getting is just shavings, right? It's not nuggets anymore, and it's fine. Those were like great things to have in the market. There's a lot of really good players in there right now, but if you try and compete at this point, you start to look a little bit more like a commodity, and you're competing against somebody who's huge and already figured this out, and it's a real uphill battle, and there may not be enough innovation left to differentiate you, which is why I love what we do, because we don't really have a lot of competition at this point. We got like a gold faucet, right? Because we are the best at what we do, and nobody else really comes close. So, I appreciate the position we're in, but you look at some of these fintech processors, and it's like I can't really tell what differentiates you from another processor that is more trusted and larger and has been doing this for 15 years, which is a long period of time at this point, for fintechs. So yeah, it's a good market, but it's probably it will take a while for things to sort out, and it became a little oversaturated.
Dave, you mentioned that they're competing with banks and institutions that have been doing this for years that also have huge teams that, have built upon expertise in-house. But there's also a lot of things that they could probably learn from these institutions
Yeah.
not to do. And that's where I think you see these, fintech processors succeed, is learning what not to do from banks. Do you guys want to expand upon that? I know you've seen a lot of really good examples of this in the market.
I think banking in general has shifted a little bit from, what it used to be, which was if you were a consumer and you had a relationship with a bank, you valued that relationship, and you're almost like afraid that you might lose it. Like this is a big, powerful institution, and I'm so glad that, my credit's good and stuff like that. And I think those relationships are a little bit more exchangeable now, and you can sort of go across the street and get a card from Walmart if you don't like your card from Wells Fargo or whatever. So there is some good that came out of that in I think consumer choice and their ability to play the market a little bit. If you like dogs and you buy a lot of dog food, there's a card for you and you'll get more rewards. And some people are really into that, and that wasn't always a thing. But again, there's kind of an upward limit to how great that is and how many cards we need and things like that.
Yeah, no, I would add to that. Most of these people, every single person that's founding a fintech and starting a fintech for one reason or another, they all come from banking. And I've seen really two types of people. Person knows everything they knew about banking. They've learned there for 15, 25 years. So, there's two types of people that start these companies, right? And One type is, they come in from the bank and they simply try to replicate everything they saw in the bank that they worked for. And I 100% of the time those people will fail. If you're not coming in with a new idea and a new way of doing something and a way to innovate whatever your problem you're trying to solve, I guarantee you won't make it. And we see it a lot. I mean, it's probably half of the fintechs I've talked to are people that are just trying to replicate something they saw at banking, but maybe in a newer way that's a little more cost efficient or cost effective, and it just doesn't work. You got to innovate, right? Fintech is about innovation. You've got to come to this space and really do something new and challenge the status quo and disrupt the process. And that's where people will see successes. I mean, in the fintech processors and all the way down, right, to companies like us that have a niche kind of use case that we're solving. And unfortunately, it's like 50-50 from what I see, just people taking what they did at the bank and trying to do the same thing at a fintech, and it'll never work. Can't compete unless you're doing something different.
Yeah, we did a very good job of knowing what we did at Bank of America. And, when we founded the company, we had a laundry list of things that we would do over again and that we would never do again because of that experience, and there's a lot of companies out there who are just, well, I think I can do exactly what they did, but just do it better. But again, these are big machines. They've been in business for 100 years. They've perfected what you're trying to do. You've got to be more, crazy than that, I guess, for lack of a better term. And we constantly are looking for ways to sort of upend how this has been done, for decades, really, at this point at these large banks. And we're constantly challenging how they look at it. The ACH thing I brought up before, great example. People have been signing their names to WSUDs since paper existed, probably. And, now, we come along and we're like, well, we don't need to do that anymore. And, you've got to have that kind of mindset, or somebody else has already figured out the best WSUD process. Who's figured out the best process without a WSUD? That's what we're interested in.
Are you seeing for banks, so traditional institutions, are you seeing more of a willingness to buy versus build to, maybe compete with some of these fintechs that are being more efficient in their internal operations or being more efficient in their in-house solutions to manage challenges like fraud and dispute management?
From where we started 6 years ago to today, the whole landscape has shifted from a build to a buy, especially in the larger institutions. I think it's sort of the technological revolution of the 90s and early 2000s, and everybody sort of thought they could build, and they spent millions and millions and millions of dollars, tens of millions, hundreds of millions to solve these use cases with technology. And then they ran into problems where that's a lot of money to spend to solve technology, and then you have to continue to maintain it, and then you have to continue to upgrade it and make it better. And then so now you didn't just spend that once, you got to keep spending that money. And it is far, far cheaper to spread the wealth, especially for compulsory types of use cases like ours, to let us service hundreds of different brands and financial institutions. And now you all sort of share that cost, right? And then you share the ideas of getting new enhancements into the product or upgrading your software. And you as a bank, you don't have to worry about it. I would say the largest waste of capital at a bank today is building your own technology. I mean, hands down, there's not even a close second when it comes to how to waste money. It's not a good idea. This isn't what you do every day, right? Let somebody else handle this for you and focus on being the best bank you can be. And I would give that advice to any banker any day of the week. Stop trying to do this on your own, because you're not a tech company. You're a bank.
Yeah.
Do bank things.
To your point, like fintechs, this is in their DNA. When we started Quavo, we knew we needed all kinds of things: servers, email, HR, whatever, all kinds of things. And we went and found the best provider of those technologies, Microsoft Office, AWS, whoever, all this stuff, because we knew this wasn't our core business. And if we were going to survive as a small company, we couldn't invest in all of these things, right? But as you get to become a bigger company, you think you can build all these things. You think you're special and custom, and let's build this stuff, and it'll be tailored to our needs. But fintechs never really grew up with that. They grew up the same way we did. Well, I'm just going to pull this thing off the shelf. It's already the best, and that's how they built their company. And you make 100 decisions like that, and it is a huge competitive advantage over a bank that builds everything themselves. Because like Joe mentioned, it becomes this boat anchor, right? Now you bought it and you own it and you have to maintain it. It's like the classic car that's in your garage that now you've got to maintain this thing, and you thought it would be really sweet to have this car. And it's almost painful watching some of these implementations, because we know that Reggie's Reggie and Visa's Visa and Mastercard's Mastercard, Nacha's Nacha. There is a best process already, and we've already built it. That's not to say that it wasn't a significant challenge. It took us a long time, and that's why I know that any bank that's trying to build a custom dispute solution, they're embarking on at minimum a 6-year journey. And for what? It's not their core business. It's exception processing. It's literally by definition not their core business. So, we look at that and see that opportunity, obviously. But to your original question, there is a much larger appetite for that right now, because big banks are looking at these fintechs and they're like, well, how can I compete with that? And they play to their strengths. They have this great customer base. They have millions and hundreds of millions of relationships, but they need to think about how they run their business like a fintech does. This isn't my core business. I'm going to go buy it. This isn't my core business. Who's the best at it? Go get it, and little by little, those hundreds of decisions, they unwind them. And banks are starting to get a little more nimble, and they are starting to resonate with our message and the fact that we've got this problem solved already.
It's funny because I was actually talking to a more mature fintech that's been around for a while and grown and is very successful now. And they were talking about fraud and dispute management. This was that Money 2020. And one of the things she said is, we're dealing with a lot of customer service issues. And so what's been put on my desk is, let's build like a call center. And she said, I refuse, as a fintech, as somebody that's innovative, to build a call center in-house. I refuse. I absolutely hate that, And it's funny, it kind of comes full circle. You get these fintechs that are successful now facing the same challenges that these traditional banks are with trying to build things in-house or keep things in-house. And they have to remember, where were our roots, Where's our core?
Well, I mean, we've gone through the same evolution. I mean, look at what
Yep.
we're doing with Dre, right? I mean, we recognized pretty quickly we're not a processing company. So, let's go find somebody to outsource this to, right? And that's when we partnered with iEnergizer. And I'll tell you, we've had prospects ask us about call center. Can you do a call center? And the answer is yes, we can. And we're just going to outsource the iEnergizer because we're not a call center company.
Mhm.
Happy to take on and have somebody have their whole shop from intake at the call center through the back office processing with Quavo, but we're not going to do all that work. We recognize what we're good at and what we're not. So let's outsource that to another partner to manage that work for us. I mean, and if you're not doing that, if you're trying to do everything yourself, you're going to be in a lot of trouble. Nobody succeeds that way. Nobody succeeds trying to focus on 100 different problems at once, right? Solve the things you're good at solving, outsource everything else to somebody who's exactly good at solving that problem. And that's what we, that's what we do, and that's what we recommend to our partners and our clients as well.
Yeah, and that's our niche, right? If you have a disputes problem, and if you're not using our solution, I know you do, you should reach out to us, and we are going to solve that one problem for you. We are not going to, we will help you with your call center problem, to Joe's point, but we are very good at what we are doing, and we don't necessarily step outside the lines all that much, and it helps keep us successful. It keeps our clients successful, and it's how you survive as a business. That's what we want to provide, is like the best of what we're doing. And that's that's why we are getting a lot of traction with our message, because we're not offering this watered down giant package, right? We're solving a problem the best way, very specifically.
Do you guys have any closing remarks as far as 2023 predictions go in the industry, or anything that, you wanted to mention earlier that you weren't able to?
In terms of predictions, I mean, the economy's tough right now. We are in an interesting spot in what we do, and that do well when the economy does well, but we're also counter cyclical, or we do well when the economy doesn't do well. But I expect fraud to continue to rise through the year, especially if we go into a full-on recession. And that's something to watch out for, right? Because you've got two problems. You've got fraud and disputes on the rise, and then you've got also this need because of the recession to cut costs. So I obviously positions us pretty well to help our clients out on both fronts, right? We can help you work through your fraud, keep you compliant, keep your your losses down, but also reduce your expenses at the same time, to really solve both of the problems that any financial institution is going to see throughout the next year in the downturn economy.
Yeah, I think you will absolutely see first party fraud on the rise. It's pretty easy to predict that when there's a recession, there's going to be layoffs. But what's the cascading effect of that? You get people who are a little bit down on their luck, maybe missing a rent payment, something like that, and they, take a chance on defrauding their issuer and, filing a dispute and things like that. At the same time, you have these banks who are under pressure to investigate and get to the matter of this dispute as quickly as possible. No bank wants to, accuse their cardholder of deception if they're a good customer. I mean, that's the opposite of what you want to do, right? So at the same time as they have to reduce their workforce, they have to deal with like very real rising first party fraud because of financial challenges that people are going through. So, that's my prediction. First party fraud way on the rise, staffing at low levels, and how do we solve that problem? For us at Quavo, it's going to be data and knowledge and automation as much as possible. Getting, again, to the root of the matter as quickly as we can without involving staff. That's how we make our clients successful.